All right, guys, let's quickly take a look at that upcoming US data in the form of jobless claims and the PPI. Now, in terms of how we are looking to trade this, I'm leaning more towards trading this as a miss today, as opposed to trading this as a beat. Don't get me wrong, if we do get a solid beat for these two data points, it can be market moving and it might be enough to get the markets taking that hawkish Fed dot revision a little bit more seriously than they did yesterday. But to be honest, after the FOMC, which in my opinion was more balanced and with a slight dovish tilt after the big miss we had in CPI yesterday, I just think the simpler trade, the trade that flows more in line with the path of least resistance right now, is to hope for a big miss and trade that in line with the same reaction we saw out of CPI yesterday. Again, don't get me wrong, if PPI comes in massively hot today, and I mean really hot today, it can indirectly impact things like PCE, which is the Fed's preferred measure of inflation. And if we get that number coming in like just insanely hot, then maybe that could potentially see the markets taking yesterday's hawkish revision a little bit more seriously. But, I'm kind of leaning more towards the previous PPI reaction from the markets, where despite PPI moving higher last time around, if we take a look at the charts, despite it moving higher, the markets discounted very quickly. Remember that was the euro. Let's quickly go back to euro dollar. That was that euro dollar trade that we traded to the upside, where we anticipated the markets to basically discount the PPI data. Now I am leaning more in that same direction, meaning that if we do get just a marginally higher than expected number, it might provide us with a similar opportunity to basically short the dollar maybe from better levels. But I am far less confident of that type of trade this time around. I don't want to turn a really good trade yesterday with the CPI into a really bad PPI one today. I just want to keep it as simple as I can for this one. And that's why I think the only opportunity that seems like the most obvious one, the simplest one, I would never use the word easy, but dare I say it, the easier one would just be to hope for a massive miss and to trade that. That's my preference. And if it's a marginal beat, we could look, like I said, for lower risk fading opportunities like we did last time. If it's a very big beat though, I'm just going to ignore it. Because I think the markets will be able to discount a marginally stronger number, but I'm not so confident this time around, because we had a different type of setup for the markets last time around, right? We had a Fed which didn't reprice hawkishly. We had positioning which was still massively stretched on the long side for the US dollar at that time. We didn't have to worry about a lot of those things that we have to worry about now. So it's a lower conviction fading opportunity if there is one. It's possible, and I will go through how we could potentially look to trade that, but I'm going to keep my powder dry for a miss. If it's a massive miss, I want to short the dollar on the back of that, potentially get long equities on the back of that. If it's a massive beat, I might just ignore it and see how the markets play out first. Remember, you don't always have to trade each and every single outcome, right? If there's an outcome like today where you just feel a little bit unsure about how the markets are going to trade it, it's okay to sit out of it, right? It's okay not to have a position going into it, or not want to take a position out of an event if it falls in line with something that you're not sure how they're going to react to. And that's exactly how I feel about this PPI print. So my preference would be to look for a short. I will go through what could potentially happen on a big beat, but again, I'm not going to trade that personally. I would rather just stick to the simpler one right now, which I think is just to see a miss in line with the CPI print that we had yesterday. Now, the one thing just to keep in mind about today's data, remember, it's not just PPI. We actually get the jobless claims and continued claims numbers coming out as well. So if I'm looking for a miss in the PPI, it means I'll be looking for a miss in claims data as well, where I'll be looking for a higher number. Remember, for claims, the higher it goes, the worse it is for both initial and continued claims. So they'll be looking for a much higher than expected print, a miss in that as well. My trigger for that to really create some momentum, especially after Fed Chair Powell spoke about the labor market so much yesterday. The Fed, even though the Fed has been like hyper sensitive to inflation they are definitely starting to talk and be more concerned about the other part of their deal mandate, right? They are definitely more concerned about the labor market than they were just 4 and 5 months ago. Their language have really started to really emphasize labor. So for them, if we had to see initial claims moving into that threshold that we've been looking for over the past few weeks, which is a number between, let's just say 250 and 260. If we were to get to that type of level, that will really matter to the markets, right? So if we get a big miss in PPI, and that is also followed up by a big miss in claims data, like a number, like I said, above, let's just say between 240 and 260, I mean, that'll just be the perfect dovish type of outcome that we can hope for today, right? What's good about today's initial claims number is that the maximum expectation is 244. So I'm just going to keep it simple and aim for anything above that. If it's 244 or higher, that'll be really bad, and that should get the market's attention, especially after Fed Chair Powell's emphasis on the labor market that we had in that FOMC presser yesterday. So coming back to the PPI data then, which is going to be the more important ones. What type of numbers are we looking for? Well, as always, what we want to see is ideally we want to see a miss below the consensus. It'll be great if we can see a move below the prior as well. And we'll obviously be hoping for a move below the market's minimum. That's like the basic way that we can look at it. But we can take it a step further by also looking at the forecast distribution, the breakdown of all of these votes to see whether there might be some outliers that we can then use to exploit for slightly better opportunities. Now, let's start with the first one then. Let's go to US PPI year over year. Now, if we go to US PPI year over year, we know right now expectations. This one is a little bit tricky. It is a little bit tricky because the prior for this is 2.2. The market's already expecting this just from normal expectations already to go from 2.2 all the way up to 2.5. That does make it, slightly more complicated when we trade it. But it doesn't have to be as complicated. It just means that the threshold there is going to be slightly, it's going to be slightly bigger because we want to have a good enough confidence to trade it. So what do I mean by that? Anything below 2.5 will technically be a miss, right? If we get 2.4 or 2.3, that'll be considered a miss. But for us to have really, a big enough confidence to see it as a miss, we ideally wanted to see it as close as we can to that 2.2 level. Why? Because we want to see it either in line with prior or below preferably. Now, because the market's already expecting a big jump from 2.2 to 2.5, it might be a bit of a stretch to aim for something below the prior, right? And again, if we go just below 2.4, that will already be below the market's minimum expectation, which should be good enough for a miss, right? But ideally, and we're talking about the ideal dovish outcome, we want to see a number that's equal to or lower than 2.2. Again, that'll show no acceleration when the markets are expecting it to go higher. That I think could be a good possible trigger. For the month-over-month number, we'll be looking for anything like 0 or lower. Why? Because anything below 0.5, take a look at this. Let me grab the forecast distribution there. Anything below that 0.5 is already going to be below the prior. The prior is 0.5. So whether we get 0.4, 0.3, 0.2, 0.1 or 0, that's already going to be below the prior, right? But again, we want to see some type of miss because the markets are expecting this to come in at 0.1. We'll just be looking for a marginal miss. I think anything below 0.1 should be fine. Again, anything below 0.5 might already do the trick, but we want to see that red number, right? We want to see red on the screen. We want to see a miss of some sort. So 0% there should be a good enough print to look for a miss. Now, in terms of core PPI, year over year, 2.3 or lower is what we'll be looking at. How did we get to that number? If we go to the chart once again, we can see that 2.3 is the outlier here to the downside. It's marginally below the market's estimates, which is 2.4. Why would that be enough for us though? Because if we take a look at the prior was 2.4 as well. So if we go to the charts here, let's just quickly bring up PPI here. Even though that won't give us a new cycle low, that's a little bit further down. Anything below 2.4 is already below the prior, and that's already going to be a miss versus market expectation. So if we get 2.3, even though that is the market's minimum expectation, I think that's going to be enough. So 2.3 or lower should be good enough for a dovish surprise, if you will, for the core number. In terms of core month over month, here in the markets are already expecting, just like the other one, for this to actually push lower. So we can see that the prior for this was at 0.5%. Prior was 0.5. Expectations for this is 0.3. So technically speaking, anything below 0.5, whether that's 0.4 or 0.3 or lower, is already going to be below the prior, which again should be good enough, but the market's already expecting this soft as 0.3. So we want to see just any type of miss on this one, right? So 0.2 should do the trick, or below. So 0.2, anything below 0.5, like we said, is already below prior, but a miss would be welcome, right? We want to see a miss. So in terms of potential reactions, you guys should know this by now. If we do get that ideal dovish outcome, we would expect dollar downside, yield downside, equities up, and gold to move higher. Now, in terms of possible, I'll leave the trade scenarios for later. In terms of the inline outcome, that should be self-explanatory. There is a possible trade there. I'll explain that in a second. In terms of the hawkish outcome, now again, I said it here, I'm reluctant to trade this. And I would prefer to stay patient on this one. But if you are a die-hard, dollar bull and you want a reason to long it, then these are the types of numbers that I would look for. And I would keep this super, super simple. I'll be looking for a number above the prior, above the max, and an outlier in the distribution. What do I mean by that? If we go to the year-over-year number here, you can see here that year-over-year, the maximum is 2.7. Now, the prior for this, right? The prior number for this was, let me just quickly go back here. The prior number for year-over-year was 2.2. So, anything above this is obviously going to be already, higher than the prior. So we already have that even if we just get consensus. But because a beat is not the most attractive trade, we want to have a real shocker of a number. We want to go above the maximum, obviously above the prior, and we want to have it above that clear market outlier. In terms of the year-over-year core number, let's quickly grab year-over-year core here for a second. In terms of year-over-year core, same story there. Maximum expectation there is 2.6. It's already going to be above the prior, even if we just print there, because the prior was 2.4. So I'll be looking for 2.7 or higher for that. In terms of the month-over-month measures, same story there. We'll be looking for a move above the max, so 0.3 or higher for the month-over-month headline. And in terms of core month-over-month, they will be looking for a number like 0.4 or higher, which again is above the market's max. Now, again, I think the simplest way to express that type of trade would be euro-dollar shorts. Why? Because the euro is obviously pressured right now with all of the political stuff going on with France. That's the simplest way to express that, would be dollar longs. But again, I'm reluctant to trade that myself today. I'm going to stay patient if it's that type of a beat. The other potential trade to look at would be gold shorts. Why? Because positioning is still very, very stretched on the long side for gold right now. So that does pose some downside risk if that number should come in. Super, super hot levels there to aim for would be 2291, which is that level of support. Below that, round numbers, probably your best friend to the downside. Now, one thing just to add is what happens if we get this coming in exactly in line with expectations. We get the year-over-year at 2.5, the month-over-month headline 0.1, core year-over-year 2.4, and core month-over-month 0.3. If we get exactly in line with expectations, we normally wouldn't expect any reaction, right? We would expect flat dollar, flat yields, flat equities, flat gold, because there's no edge, right? If it's an as expected print, that means markets shouldn't be surprised at all, right? But it would mean a higher year-over-year and a lower month-over-month, which is a little bit messy. But there is an opportunity here for a low conviction dovish outcome trade. Why? Because if the markets were able to respond the way that they have, this out of the CPI and discount what the Fed said, then an as expected PPI print shouldn't change anything, right? An as expected PPI print, which shows upside for the year-over-year but downside for the month-over-month, that shouldn't change anything in my view, which means that the markets might be able to discount that and potentially trade in line with the CPI reaction from yesterday. So there could be a low conviction opportunity there, but I would prefer to see how the markets react before jumping into anything like that. So that's just a quick preview. Now, in terms of levels, what I'll be looking for a dovish outcome, just like yesterday, I'll be looking for Kiwi dollar longs and T-bond longs. My preference yesterday was the Kiwi. We had a beautiful trade on that, trading that to the upside. Even with a bad fill, we were able to push right into that key level of resistance around that 62.10 level, which we looked at. So I'll be aiming for something fairly close to those highs like we did yesterday for a potential massive dovish outcome. I'll just be sticking to the Kiwi. Once again, it's a currency that I like from a fundamental point of view because it's one of the most hawkish central banks, relatively speaking, right now compared to any of the others.